Hello everybody, this is Ilya Spivak, currency strategist with Daily FX, and we are going to be doing our outlook for the financial markets for the week. Before we get started though, if everybody can please type into the chat box that I've set up next to the video screen, let me know if you can hear me, and let me know if the audio and video are both going okay for everybody. All right, looks like we are in good shape. Let's start here. I have, of course, the chart of the US dollar up on the screen. This is the Dow Jones FXCM US dollar index. And as you can see, we made that critical break through resistance at the top of this this channel and cleared this congestion area here as well. So it looks like we are poised higher, but we've not made meaningful headway since making the break. So we'll have to see how this develops this week. But from the looks of things, at least from a technical perspective, the positioning suggests that the path of least resistance for the US dollar at this point favors the upside. We do, however, have a tremendous amount of event risk that can potentially impact the situation here, not the least of which, of course, will be Wednesday's release of minutes from the October 30th FOMC meeting. And what we're going to be looking for there is, of course, anything that suggests where the Fed is seeing the impact of the October government shutdown and how badly the Fed expects this to have hurt the economy. And of course, from that perspective, the market will attempt to get a sense for what all of this is likely to mean for the outlook on tapering of QE, which continues to be the focus for speculation and essentially the fundamental sort of prism through which we are interpreting U.S. economic data. Now, the tone from the actual FOMC policy statement in October was substantially less dovish than people were looking for, but of course, after last week's commentary from would-be Fed Chair Janet Yellen, now Vice Chair, but of course nominated to take over from Ben Bernanke when he is done with his term at the end of January of next year, has probably primed the market once again in a dovish way. And so if we get a fairly sanguine set of minutes here that doesn't show officials are particularly concerned about the impact of the shutdown, that may actually drive taper speculation and could be the fuel that allows this US dollar to make its next run higher. As far as other event risk, we of course have Wednesday all the way packed with October's retail sales number, October's CPI number as well, and expectations there for core CPI to actually remain unchanged at 1.7% year on year. Retail sales expected to improve a little bit and give us a 0.1% increase in receipts in October. So another sort of case in favor of a sooner move to taper QE potentially as opposed to later. So that again can serve as possible fuel for this US dollar to make its next move. Looking through the sort of possible impact on the majors and various positioning around the majors, a couple interesting setups stand out. I'm actually holding short euro US dollar at this point. Still holding it from when I got in last week. And the chart on the weekly, this is the actual chart that I got in from, looks kind of like this. I got in once we got this bearish engulfing here with the break of the channel line down here. We corrected higher last week, which looks to be a sort of textbook retest of former resistance, or former support rather, turned resistance, and I'll be looking for downside momentum to resume from here. In fact, if you take a look at the daily chart of euro dollar right here, you'll notice a fairly textbook retrace here. And if we actually look at just this leg here, you can see that we have a very clean retrace right back to the underside of this channel, as well as the 38.2 fib at essentially 135. And I would expect us to turn from here and sort of resume the sell-off. We did have a very interesting development, as a matter of fact, in dollar yen. But before we touch on that, as far as fundamental event risk goes, we do have some interesting fundamental event risk on the euro side of things. We have the zoo economic expectations survey that's coming through on Tuesday, and expected to see analyst sentiment firming, which might be a little bit of a support for the euro area, but unclear whether that support is going to come from the idea that the economy is doing better, or from, of course, the fact that the ECB moved to unexpectedly cut rates, which, of course, is positive for growth, not necessarily the euro. So an improvement in sentiment here need not be euro supportive, because, of course, it's not going to necessarily translate into expectations of any kind of tightening on the part of the ECB. Quite the contrary, it may be a reflection of the easing. So I think that at this point, that's not necessarily something that's likely to drive the euro higher. Later in the week, we do get something a bit more compelling. The preliminary set of November's Purchasing Manager Index, PMI numbers. Those are due on Thursday. And that actually is probably the best reading, early, timely reading on the business cycle that gives us a sort of window into what might be happening with overall growth, with GDP. And when we look at expectations there, the composite index, which includes both manufacturing and service sector activity, expected to see a narrow pickup. That might be actually something that gives the euro a bit of a lift, but the number is expected to be a fairly narrow improvement. So there's a lot of opportunities here for essentially a flat outcome that doesn't really yield any kind of meaningful response. Expectations are for a print at 52 versus 51.9 in the prior month. So a very, very narrow improvement there. Furthermore, if we take a look at the trend in Eurozone economic data relative to expectations, we actually see that data has underperformed expectations by an increasingly wide margin, essentially over the past 2.5 months. So we certainly have scope for a downside surprise here, which may, of course, weigh on the euro as we continue to speculate that the ECB might have to do more given sort of the token nature of the rate cut, as we've been discussing for a couple weeks now. Obviously, the baseline rate for the ECB is actually much higher and was much higher than the actual market cost of euros. The average overnight bank lending rate, the Ionia, is actually averaged around 8 basis points for almost half a year now, whereas the ECB rate, obviously, before the cut was 50, now is 25. So really what we've done with this cut is we've just brought the baseline rate closer to what the actual cost of euros in the market is. But uh, as far as actually giving any significant easing, there's really not a whole lot to be had there. So we thereby continue to speculate that if deflation becomes a serious concern, obviously after the October inflation number was confirmed at 0.7% last week, we might actually get speculation on further easing and probably something more concrete. We had comments from at least one ECB policymaker last week suggesting that they're open to doing QE, they're open to negative deposit rates on the ECB deposit facility to sort of punish banks for holding money on reserve and get them to lend it out and thereby loosen financial conditions further. So we continue to look at the possibility that downside surprises could really ramp up that speculation and drive this euro lower. On Friday, we have another sentiment survey, this one, the IFO Business Confidence survey coming up, and again, a narrow improvement expected there. The expectations index expected higher from 103.6 to 104. The composite business confidence index expected slightly higher from 107.4 to 107.7. Narrow improvements, all of them, but still essentially the door being open to downside surprises. And so opportunities there for the euro to find a downside catalyst, potentially. But I alluded to a setup in dollar yen, and that's actually what I want to move over to take a look at here. Notice that we have finally cleared the congestion that we've been looking at in dollar yen. This is the weekly chart, of course, and we've finally broken this consolidation triangle and actually closed narrowly above the 23.6 fib expansion here at 100.06. The close for the week at 115. If you take a look at what's happening on the daily chart right here, we're actually retesting this former trendline support that's now been recast as resistance, and there's a shooting star candle here, which is a bit worrisome, and which is a reason I wouldn't get in long at the immediate moment. But considering we've made the break on the weekly, it is compelling, and it is something that I would be interested in potentially trading. So you'll notice the high here on this shooting star is at 142. The close on this top, the high is obviously 160, but the close here is 138. So essentially, if we take a look at this top, it's basically where we tagged a couple pips over on the high here. So there's a reinforcement of resistance right here. And if we see a pullback from this area, in fact, let's actually draw this line in here so you guys can see what it is that I am referring to. There we go. So there is that close at 138 right there. So if we see a pullback from here, I would be looking for that as an opportunity to get long and start to look for significant dollar-yen upside. If we take a look at where the break on the weekly implies our next objective, we're looking at almost 104, so 103.94. So I would basically want to see a bit of a pullback here and then look to get long. Certainly if we get a supportive set of Fed minutes, that would go a long way toward driving this higher. I think what is important to consider, as we discussed last week as well, is that if we build taper expectations, we may actually see risk aversion. And if we see risk aversion, we're likely to see an unwinding of carry, much of it, of course, funded in yen. And in as much as dollar yen does not exist in a vacuum, although it itself is not really a currency type of pair that encourages carry demand, there's obviously not a lot of carry to be had in dollar yen. If you see massive selling in more standby carry type of setups like an Aussie yen, a Kiwi yen, even sterling yen, things along those lines, you are going to see spillover likely into dollar yen, and so that might actually catalyze the pullback that we need in order to begin to trade this. So that's what I'll be watching for here and sort of looking at as a possible setup to come out of this U.S. data set that we have on tap this week. Elsewhere in the majors, sterling is actually an interesting setup, and sterling seems to have made something of a near-term break higher. Notice this right here is, of course, the weekly chart of sterling, and I've been talking for a couple weeks about the idea that I don't want to enter this short until we clear this former level of resistance, now recast as support, the trend line from April 2011. You will notice we continue to hold this level. And so although we broke through this trend line here that sort of guided this upward recovery, we still continue to stubbornly hold this level. And so I'm going to stand aside here for the time being and wait because it looks like the decision not to get in as we started to dip through it was actually quite wise, because we actually found support right here at this 23.6 fib. This is, of course, the daily chart. And after stalling a bit at this falling trend line, actually broke higher. At this point, looking at this, so this former top and the underside of this trend line here as resistance, coming in at 162.42 or so, and essentially looking for sterling to perhaps meet some resistance there again and maybe come off this range top up here once again, but and make for a triple top. So we'll see how that plays out. At this point, no confirmation one way or another. The big question this week, Wednesday's Bank of England minutes. unlikely to produce really much that is new, much that we haven't seen, because of course we had the quarterly inflation report last week, and that went a long way toward guiding what we expect from BOE monetary policy. If we get that same sort of sense from the minutes, which was, of course, a relatively sort of balanced outlook, but with a revision to growth expectations, with a revision to unemployment expectations, but still a commitment to keep rates low, we might actually see sterling a bit higher as we sort of get the sense for how people voted on the MPC. If the vote was unanimous to basically maintain things as they are, probably not a whole lot of volatility there. But if anybody on the committee voted to revise the amount of QE or begin to scale back asset purchases, which would be, of course, very dramatic and seems relatively unlikely. But if the vote was not unanimous on the hawkish side, we might actually see a fairly significant push higher from sterling. We'll have to watch and see how this plays out. My sense is that we're going to get a relatively status quo outcome, and it's going to be a bit upbeat, but and that may give sterling a bit of a lift, but we're not going to get major policy innovation that is alluded to in these minutes, and we're probably going to, I think, get another unanimous vote. Looking at the Aussie, we've actually made a very interesting move here on the Aussie. Notice, this is the weekly chart, we pulled back from the 50 fib of this decline, and we are currently testing the 23.6 fib expansion of this decline, followed by this correction, so a 3-point based expansion. And we've put in a hammer candlestick right there, right at that level, suggesting we might actually be looking at another run higher here, potentially, from the Aussie. We'll have to see, of course, how it plays out. A hammer is not something that has adequate confirmation in and of itself. Looking on the daily chart, we actually have the beginnings of what this setup might look like. So notice we stalled right here at the 50 fib in this former bottom at 93.02. We put in a bullish piercing line candlestick pattern right here. So this pattern right there. And what we need now, arguably, is confirmation on a break of this channel. Now, if this is in fact a move that is signaling a near-term bottom, then what we might do is reimagine this again as a 3-point fib expansion, where this is the initial leg of the rally. This is the correction. And if that's the case, which of course we don't know yet, so it's still an if, but if that's the case, then the first upside objective here comes in at 94.82, which is the 23.6 fib level. So if we take out this channel top, I might be looking for an opportunity to perhaps get long again. Those of you that were following the last time I did this, I got in at about 92 and booked out about like somewhere near the stop. I believe it was 270 pips that I booked on it. So maybe this calls for another try on the long side. So I'll be watching this closely to see if the setup presents itself. Looking at the Kiwi, we've actually rebounded rather significantly in the Kiwi, and I'll show you guys the chart here. We'll start off as we did with the Aussie with the weekly chart. Notice we pulled back from this former channel bottom, found very clean-cut support here at the 38.2 fib, and jumped back to retest the 23.6 level at 83.40. This may still be a head and shoulders top. So the head and shoulders top that we've been talking about all last week, this may still be that. But clearly, waiting for confirmation on a close of this neckline here showed to be wise, because we clearly did not get the break that we were looking for here. Had we sort of jumped the gun on assuming that this is a head and shoulders and gotten short, obviously, it would have been a painful experience. Here's the daily right here. You'll notice we are testing the top of this trend line here, and we'll see how this plays out. If we actually get a push through here, that would go a long way towards negating this head and shoulders, but may not obviously necessarily negate it. So we'll have to continue to watch, but the overall structure of the head and shoulders with this neckline here at 82.14, that continues to hold for now. The other component, of course, of speculation on Fed policy brings us to a conversation about gold. This is the gold daily chart, and you can see here that as we've seen again a bit of dovish commentary from the Fed last week, of course, in the case of Janet Yellen's testimony, we have right here a bit of a recovery in gold, and you can see here that we actually have a bullish piercing line candlestick that's been followed up by this advance. Now we're testing right here at the 23.6 fib, that at 1294.51, reinforced by this channel top. There is a fairly clear cut, as you can see here. There's a fairly clear cut hanging man right here. And if this suggests ultimately that we're going to make a move lower, we don't know that, of course, because again, a hanging man, like a hammer, requires at least 1 day's confirmation. But if we see a move lower come out of this setup, then it would certainly likely come from something related to the Fed minutes, and indeed, if the Fed suggests that, or at least if the sense from the Fed minutes comes back as suggesting that perhaps policymakers are not so concerned about what happened in October, that would be a helpful catalyst in that sense. Let's go ahead and take your questions here. Peter is asking, if taper is on, will dollar yen necessarily go up? SPX may go down, and bring euro yen down. Well, that's absolutely right, Peter, and that's exactly what we were talking about earlier, about sort of the conflicting forces impacting dollar yen, and the idea that if we see an unwinding of carry, that could sort of spill over into dollar yen, and that may be the catalyst that ultimately brings dollar yen back and gives us this correction down here, which will ultimately allow us to get long. Eddie is saying that the FOMC this week may be a non-event, shown by last week's Yellen and China rules resulted in a high S&P. Well, not quite, because of course Yellen was dovish, right? So that's supportive of the S&P. China rules updates were supportive of growth, which is positive for risk sentiment, positive for economic growth in China, positive again for the S&P. What we're looking at from these FOMC minutes, very important. This is not an actual rate announcement. These are minutes from the last rate announcement. What we may get here is a sense that perhaps policy officials are not as concerned about the impact of the government shutdown as we just discussed, which would be negative for the S&P. So these are not things that are in alignment with what we heard last week. Now, with that said, the S&P obviously looks very buoyant. This is a daily chart of the S&P. And you can see actually on Friday we made a break through the 38.2 fib at 1790.50. Notice we continue to diverge though on RSI, which suggests that actually upside momentum here is fading. We're setting higher highs on the S&P. We're not setting them on RSI. And that's worrisome if you're bullish, the S&P. And if we get these minutes suggesting that a taper might be sooner coming than later, then we might actually see the pullback implied by this RSI divergence come to fruition. Pavel was asking, what would be your favorite currency to go long against yen for the medium to longer term? Without question, the US dollar. I want to be long dollar yen, but I want to be long it with the right setup. I think that gives us a good long-term play on the policy divergence between the BOJ and the Fed. It's one of the reasons I like euro-dollar. That's the other place where we get very, very clear-cut policy divergence with in favor of the dollar, with one central bank going clearly in the dovish direction. That being, of course, the ECB, the BOJ. The other central bank, in this case the Fed, although not tapering actively, but looking for a timing schedule to begin actually reducing stimulus. So looking to go in the other direction. So as we look at this, I think it gives us a very clear-cut picture eventually. But of course, we have to flush out the impact of risk and sentiment trends. So although, again, dollar yen is not strictly a carry currency, if you see some degree of carry unwinding, you are likely to get dollar yen initially lower, and that might be a catalyst to actually get long at a better level. Pavel was saying essentially you like Euro Aussie short. No, not at all. I don't like Euro Aussie short. I don't like Euro Aussie short for the very simple reason that while I don't like the euro and I am short the euro, I'm not altogether sold on Aussie dollar strength. I don't have confirmation of it that I can see, and I don't like the idea of essentially being long a currency where we get this kind of aggressive job boning. I would be a lot more open to being long Aussie dollar for the simple reason that Aussie dollar is sort of more sentiment linked, and so that gives us a play on taper speculation. And Aussie dollar is better reflective of Chinese economic growth expectations than is Euro Aussie. So I don't necessarily like Euro Aussie, but Aussie dollar I would get tactically long if the situation presented itself. But again, tactically long, not fundamentally long. Fundamentally, I don't like Aussie's strength, and really the chart setup tells us much of what we need to know about the the Aussie. Although obviously the recent upswing uh, gave us a bit of an opportunity, and we did capitalize on it. You can see the overall trend remains pointed down. So any kind of bounce here in the Aussie would be something I would trade tactically with an eye to get short, not not something that I would look at as a longer term setup or as a uh, fundamentally sort of significant shift in the Aussies' outlook. Nancy's asking, BOJ won't act again for months. Why are the yen pairs so aggressive? Well, because the yen pairs, as again we mentioned earlier, are very sensitive to risk sentiment trends uh, because, of course, people use the yen as carry. So if we take a look at, we'll do an example here with, let's say, something like, we can even do dollar yen. But notice here, we'll bring up a clean chart of dollar yen here. So here's dollar yen. Now, notice if we overlay a chart of the Nikkei with this, notice how closely these two track each other. Right? You can see these are very, very close. And if we take a look at something carry linked, like say Aussie yen, again, notice the very close relationship here. Same thing with something like a Kiwi yen. Right? Notice how closely these are related. Now, if we get stocks higher because people are expecting the Fed will maintain stimulus for longer, then we are likely to get yen weaker as people put on carry trade positions, which are inherently financed in yen. Now, if we go the other way and we get a sense that the Fed will taper sooner, then we get an unwinding of carry alongside the deterioration in risk appetite that you'd see in falling stocks. That's where this alignment in the Nikkei and yen crosses comes from. It has nothing to do with the BOJ, which is incidentally why Japanese economic data tends to do all of nothing, because it means almost nothing for BOJ policy. Because really what's at work here is risk sentiment. CJ has a good philosophical question here, saying, if this is a zero-sum game, doesn't matter how hard the ECB tries to devalue the euro. If the Fed seeks inflation, the euro is going to go to the upside. I don't see how that logic necessarily makes sense, because if you look at what the Fed is doing, the Fed is looking for a timeline to cut back on stimulus, whereas the ECB is clearly looking to go the other direction. They've expanded stimulus, albeit nominally, but they expanded stimulus with a rate cut, and rhetoric from ECB officials has suggested that we have a level of conversation on the ECB Governing Council that's starting to weigh non-standard measures, starting to try to figure out what they can do in addition to rate cuts, because, of course, as we talked about a little bit earlier, that rate cut was basically nominal. So, really, it doesn't seem to be logical to suggest that the Fed is quote unquote seeking inflation. Surely the Fed is seeking inflation overall, and then they're obviously not looking to fight inflation, considering there isn't really any inflation to fight. But it doesn't really seem to make sense why that policy divergence wouldn't be a downward pressure on the euro, and how that downward pressure would be somehow mitigated by this being a zero-sum game. Monetary policy is not, incidentally, a zero-sum game. Trading is, of course, a zero-sum game in the sense that for every person that makes money, somebody loses. Though, of course, I stress that whereas in, let's say, the stock market, the primary impetus of most market participants is investment income, and so people are actively sort of competing against one another. The motive behind a lot of the people trading in FX is not profit from the exchange rate. It's not speculation, right? Because much of the FX market is physical, right? It's companies that need to exchange currency for their day-to-day operations. It's the financing of international trade. So some proportion of the FX market, I would argue a very significant proportion of the overall FX market, is not necessarily driven by speculation on the exchange rate. They have to exchange currency one way or another, right? Because if a company needs to pay for a shipment of goods from another country, it's going to have to exchange currency in order to do that. And what the exchange rate is really doesn't matter. That exchange has to happen. Now, there is, of course, a degree of hedging that that company might do, but the exchange has to occur, regardless of what the exchange rate is. Same thing if, for example, a company is looking to make payroll for its overseas subsidiary, right? Same thing. That company has to exchange currency. So, although FX might be a zero-sum game, some of the participants don't necessarily care if they're on the losing end, right? Because they have to do the exchange either way. And any loss on the exchange rate is just essentially chalked up to the cost of doing business. And this is why we have banks offering forwards. This is why we have banks offering essentially currency overlay programs in order to basically hedge out that FX risk as much as possible, so that if the exchange rate is adversely impacting the physical part of whatever deal, there is a side hedge that essentially tries to nullify that out as much as possible. And so in that sense, you have companies attempting to be exchange rate neutral. But I don't follow the logic here that because FX is a zero-sum game, efforts by the ECB to ease monetary policy will necessarily fail, and efforts by the Fed to trim QE necessarily won't boost the dollar. I don't see how that logic works, really. In fact, notice the impact of ECB easing speculation on the euro already. This bar was when we first got a look at that CPI number at 0.7%. That bar did not occur because we weren't speculating on ECB easing. It occurred because we were doing exactly that. Okay, let's see. Osboy is asking, has the Fed any concern of a very high U.S. dollar in case of tapering, thus dampening exports? I don't think so. I don't think so for the very simple reason that the U.S. is not a major net exporter. The U.S. does not depend on exports to drive its economy. The U.S. is primarily an economy driven by consumption, and in that sense, the Fed would actually like a stronger dollar. Well, broadly, right? The Fed doesn't target the U.S. dollar. It's not an objective for the Fed, but sort of as a corollary to what it's doing, the Fed would like a stronger dollar generally, not as a policy objective, not as something that they're going to actively pursue. But if the Fed were to get a stronger dollar, it would likely get more purchasing power in the hands of U.S. consumers, which would encourage consumption, potentially, and encourage spending. And if that encourages consumption and spending, that encourages growth, which sort of helps to work toward the Fed's overall dual mandate, right? Because what is the Fed actually targeting? It's targeting inflation and it's targeting unemployment, right? It's looking to get the unemployment rate down. And if more people buy things, then more companies make money. Invariably, those companies might see their earnings rise, look to hire more workers, and it sort of becomes a virtuous cycle. So I don't think the Fed is really interested in weakening the U.S. dollar to help exports. Exports are not really a major concern when it comes to sort of trying to drive U.S. growth. Nancy is saying global data has been mostly soft, and the risk on move is appearances only. I would counter that U.S. that global data has really not been all that soft, as a matter of fact. In fact, if we take a look at global composite PMI, it's been fairly steady above the 50 mark. In fact, if we take a look at what PMI has been doing essentially since June of last year, it's been accelerating. So we've gone from a global PMI reading of about 50. Uh, Granted, it's been a bumpy road higher with some pullbacks, but the general trajectory has been higher. With the last print on global PMI, that was back in October that we got the last update on that. That came in at 55.5, and that was actually the highest level that we've seen since February of 2011, which is actually the post-crisis high. So really, I don't think that we can say that global data has been soft. I think it's been really quite the opposite. I think the global economy seems to be showing signs of sort of cautiously mending. In fact, if we sort of look deeper and look at global expectations or expectations for global economic growth, they've been on the rise. In fact, since early September, we've seen expectations for global GDP growth this year in 2013 uh, revised up from 1.9% to to 2%, which is actually the highest since July. So we've made quite a significant improvement over the past couple months in global growth expectations as well. So I wouldn't I wouldn't say that we have a global recovery that's disconnected per se from risk sentiment. Risk sentiment does seem to be tremendously amplified by Fed stimulus. So I do think that there is a significant possibility for a pullback, but I certainly don't think that there isn't a fundamental recovery that's taking place, and that we have a generally improving global environment. All right, looks like we're running a bit overtime here, so we'll call it a day here. I want to remind everybody that, of course, if we didn't get to your questions here, there's only so much time and a lot more questions that I would have liked to answer. So if you want to follow up with me on that, just reach out to me on Twitter at Ilya Spivak. You can really get the fastest response there, as most of you guys know already. I see a lot of familiar names in here. And if you would like to sign up for my email distribution list, you can very easily do so here to receive all of my articles, all of my trade setups, etc. You can just click that link there. And finally, I want to remind you guys that we do have a service now where we actually have the ability to have this kind of session that's not as constricted by time, where you can actually be on live with a team of Daily FX analysts every day through the meat of the crossover between Europe and the U.S., which is, of course, the most liquid part of the day, and into the U.S. session. That's called Daily FX on Demand. And if you have questions on how you can get access to that, there's a link for it. If you have any further questions, of course, feel free to tweet me or shoot me an email, and I'll be happy to answer any questions on that. Thank you, everybody, for joining me. Good luck this week, and I'll speak to you guys soon.